Ladies and gentlemen, good afternoon and welcome to Apar Industries Limited Q4 and FY22 earnings conference call hosted by 4S Services. As a reminder, for the duration of this conference call, all participants' lines will be in the listen-only mode. There will be an opportunity for you to ask questions at the end of today's presentation. If you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touch-tone phone. Please note that this conference is being recorded. At this time, I would now like to hand the conference over to Mr. Nitesh Kumar of 4S Services. Thank you, and over to you, sir.
Thank you. Good day, everyone, and welcome to the Apar Industries Q4 and FY22 earnings conference call. Today on the conference, we have with us Mr. Kushal Desai, Chairman and Managing Director, Mr. Chaitanya Desai, Managing Director, and Mr. Ramesh Iyer, Chief Financial Officer, Apar Industries. I would now like to hand over the call to Mr. Chaitanya Desai for his opening remarks. Over to you, sir.
Thank you. Good afternoon, everyone, and a very warm welcome to the Q4 and FY22 earnings call of Apar Industries. I will start with an overview of our performance, followed by a quick industry update, and then get into details on the segmental performance, post which we can open the floor to questions. I am happy to announce a good set of numbers for Q4 FY22 in what has been a very challenging environment on the commodity inflation, freight and logistics front, and in this geopolitical environment. All three business segments contributed to this performance. For Q4 FY22, consolidated revenue came in at 3,018 crore rupees, up 58% year-on-year, driven by commodity price increases and expansion in newer geographies. Exports revenue was up 67% year-on-year. Contribution was at 40% versus 38% in Q4 of FY21. EBITDA was up 70% year-on-year to 181 crore rupees with an EBITDA margin of 6%. PAT came in at 83 crore rupees, up 73% year-on-year with a 2.7% margin versus 2.5% in Q4 of FY21. Consolidated revenue for FY22 came in at a record 9,346 crore rupees, up 46% year-on-year, driven by expansion in newer international markets and of course supported by higher commodity prices. Export revenues were up 35% year-on-year with contribution at 38% of overall sales versus 41% in FY21. The oil business recorded all-time high volumes at 461,489 KL in FY22, up 16% year-on-year. FY22 EBITDA grew 36% year-on-year to 574 crore rupees with steady margin at 6.1%. PAT was up 60% year-on-year to reach 257 crore rupees with 2.7% margin versus 2.5% in FY21. It is noteworthy to mention that in spite of the sharp increase in commodity prices and also the cost of funds, the profitability improved, which is fundamentally attributable to a better product mix across all three business segments. I will now cover a few industry highlights. Outstanding dues of DISCOMs rose 11.8% year-on-year to 1,17,390 crore rupees as of March 2022. 14,895 circuit kilometers of transmission lines were added in FY22, down 11% year-on-year, while substation transformation capacity addition grew 37% year-on-year to 78,982 MVA. With the focus upon PM Gati Shakti, the highest ever capex has been planned by the Indian Railways for FY23 at 2.45 trillion rupees, up 14% year-on-year. Under the Atmanirbhar Bharat initiative, Railways will bring 2,000 kilometers of rail network under Kavach, indigenously developed world-class technology for safety and capacity augmentation. 400 new Gen Vande Bharat trains will be developed in the next 3 years, along with 100 PM Gati Shakti cargo terminals for multimodal logistics facilities. The current geopolitical environment has forced India to further expand its defense capabilities. Budget FY22 has allocated 5.3 trillion rupees, up 10% year-on-year, with 68% earmarked for procurement from indigenous companies. For the automotive industry, higher inventory levels, lower replacement demand, and negative retail sentiments due to higher retail prices are expected to hamper the demand of automotives in the first half of FY23. I would now like to cover segmental highlights. Conductors revenue in Q4 of FY22 grew 80% year-on-year to reach 1,502 crore rupees with 9% year-on-year growth in volumes. Exports grew 72% year-on-year, contributing 44% to revenues versus 49% in Q4 of FY21. The higher value-added products contribution increased to 51% from 36% in Q4 of FY21. The EBITDA per metric ton post-adjustment was at 17,599 rupees. New order inflow came in at 1,095 crore rupees, up 328% year-on-year. FY22 conductor revenues was 4,200 crore rupees, up 44% year-on-year with increased commodity prices. Exports contribution to revenues was at 38% versus 52% in FY21. Higher value-added products contribution increased to 49% from 33% in FY21, with high efficiency conductor contribution at 23% and copper conductors for railways at 20%. EBITDA per metric ton post forex adjustment came in at 17,095 rupees. New order inflow was at 123% year-on-year at 5,409 crore rupees. The order book remains healthy at 3,079 crore rupees with 53% share from higher value-added products. Exports constitute 56% of the order book. In Q4 FY22, oil revenues were 928 crore rupees, up 29% year-on-year with a 13% increase in volumes. Exports contribution increased to 39% versus 35% in Q4 FY21. Lubricants revenue was 211 crore rupees, up 7% year-on-year, driven by strong volume growth in industrial oil business. The EBITDA per KL post-adjustment came in at 5,979 rupees. Oil revenues in FY22 was 3,560 crore rupees, up 51% year-on-year with 16% volume growth as the business recorded all-time high volumes at 4,61,589 KL. Exports contribution increased to 44% versus 41% in FY21. Hamdia's plant capacity utilization was up 104% from 79% in FY21. White oil sales volume was up 16% year-on-year. Transformer oil volumes was up 10% year-on-year with remain impacted due to lower demand and financial health of utilities and lower government spending. Lubricants revenue was 780 crore rupees, up 28% year-on-year. Industrial oil volumes were also up at 20% year-on-year to all-time high, but automotive oil volumes were down 7% year-on-year due to reduced tractor volumes and overall sluggishness in retail segment. EBITDA per KL post forex adjustment came in at 6,347 rupees, above the target threshold level of 5,000 rupees. The recent impact of Russian-Ukraine conflict has resulted in a disproportionate increase in refined product prices, including base oil. and this may impact the volumes in FY23 as customers struggle to accept significantly higher prices. The focus would remain on unit profitability versus volume sales. The ticket size of transactions would also limit the credit that can be offered to clients. In Q4 FY22, cable revenues reached 682 crore rupees, up 54% year-on-year, with strong growth across all sub-segments except optical fiber cable sales, which were impacted by muted telcos business. XLP cables revenue was up 52% year-on-year, and elastomeric cables revenue was up 74% year-on-year. Sales in railways, defense and wind sector, which were all affected in the COVID period, have all opened up. Exports contribution was at 31% versus 23% in Q4 FY21. The EBITDA post-forex adjustment came in at 48 crore rupees with 7% margin. Cable revenues in FY22 came in at 1,993 crore rupees, up 57% year-on-year, driven by 129% year-on-year jump in exports as the company continued to focus on international opportunities amidst challenging domestic environment. Elastomeric cables revenue was up 64% year-on-year with improved demand from solar, wind, railways and defense segments. EBITDA post-forex adjustment was up 77% year-on-year at 106 crore rupees and margin improved to 5.3%. New CCV lines and a new 2.5 MeV E-beam are under installation to expand the rubber cable capacity, especially for the wind power segment. These should be commissioned in Q3 FY23. Major focus on LDC business is planned with our new brand ambassador and a significant thrust in network expansion. Business value in FY23 is targeted above 250 crore rupees in this segment. With our unique and differentiated product, we remain confident on our aspiration to reach to a revenue of 500 crore rupees by FY26. Overall, the outlook for the cables business in FY23 is strong, with key strategic initiatives and multiple growth opportunities being addressed both domestically and in overseas markets. Overall, for the company, we are happy with the performance in FY22 and are more optimistic to deliver a stronger performance in FY23. On the conductor front, we enter with a strong order book with higher proportion in premium products and exports. On the cable front, there are multiple growth drivers in exports to USA, Australia and Africa, increased demand from the railways, defense and non-conventional energy. Our distribution of LDC products will also see sharp increase in growth and increased branding activity to increase overall visibility of our product range. The oils business will likely get impacted from the sharp increases in prices, but with the vast customer base and applications that we service, we still expect to navigate through this period. As a conclusion, we are very optimistic to deliver a good performance in FY23. With this, I come to the end of my comments. I would like to thank everyone for joining our conference call and open the floor for questions.
Thank you, sir. We will now begin the Q&A session. Anyone who wishes to ask a question may press star and 1 on their touch-tone telephone. If you wish to withdraw yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Our first question comes from the line of Pratiksha Dastari with Equitas Investments. Please go ahead.
Good afternoon, sir. Congratulations on a very good set of numbers. My first question was on conductors. If you could elaborate a bit on the opportunity and the pipeline that we have there. And secondly, on the freight front, how are things looking at on freight front now, and how do we expect margins to be impacted by freight?
So on the conductor side, we have several product lines now. So in the past few years, which were affected due to COVID, the conventional conductor business was somewhat dampened. And now things have opened up, so the volume will increase on account of the conventional conductors. Secondly, on the high efficiency conductors also, we see good potential in this coming year. There was another product line, OPGW, which was also affected in the last couple of years, but we've been getting a fair amount of business, so we see good growth prospects in that as well. And then again, on the other side, the copper railways, we see a normal year, and on the CTC, PICC products used in the transformer industry, our base is lower, so we see growth in that as well. So these will be the major growth drivers. There is a fair amount of reconductoring work for HEC and for OPGW. So there's a service component as well in this segment. And with regard to the freight, international freight costs have been stable for a few quarters now. So they are kind of remained at the higher levels. They have not really dropped. But as long as the increase is not very sharp, then what we see is that we'll be able to not lose money going forward, as we had in the last few years when we used to book business, and then by the time we had to execute, by the time the rates had gone up substantially. So that phenomena hopefully should not happen the way we see it currently.
And are we seeing any levers for margin expansion in our businesses?
The product mix, as we are concentrating on more higher value-added products, that will help improve the margins.
I think what has happened, when the mix has improved with higher value-added products, our EBITDA per ton has definitely increased, but we are not able to see a margin expansion. In percentage terms, our EBITDA margins have remained range-bound for conductor division, EBIT percentage at about 4%. So just wanted to understand if there are any levers that we see where we'll be able to expand this.
So normally we measure our EBITDA on a per ton basis, and the reason being is that the higher the commodity prices, that drives the revenue upwards. So on a higher base, with the same kind of quantum unit EBITDA, the percentage looks lower. That's the reason we normally measure our business in terms of EBITDA per ton, and that's where you see the per ton basis it's higher, but it doesn't get reflected on the percentage EBITDA, mainly because of the higher base value that it carries.
Okay. And our capex for cable division, when do we expect to commission that?
So we've had the capital expansion is continuing to run right now. There are two very large projects which are there, which will both get commissioned by the end of Q2, beginning of Q3, which are lines for these two CCV lines which are going in for making cables for wind power generation. And our fourth E-beam machine is on its way from into India, so that also will get commissioned over the next 4 to 5 months.
So
most of the capex you will see, the big ticket capex will be in place by the third quarter of this year.
Okay. And can we expect, how much time do we take to ramp up these new capacities?
So on the E-beam side, our expectation is that in the fourth quarter we'll pretty much fill it, because there's a very large expansion, as was explained earlier in the opening comments by Chaitanya, that there are a number of these new trains which are coming up.
Right.
And so the trains come along with the passenger vehicles and stuff, and there is a pent-up demand because last 2 years, as you will see from various commentary that we've had, production of both locomotives and coaches was low.
Yes.
So we see a pretty quick ramp up happening on the E-beam side at the end of the year. As far as the windmills is concerned, our expectation is to be at 70-80% capacity utilization in FY24.
Okay.
Because a lot of it will be actually a significant portion of it will be export. So we currently service all the global majors projects in India, but the main thrust for this is to then move globally and become a global supplier.
So this will be directly to the end customers?
Yes, because it goes inside the windmill.
Understood. And this is predominantly North America export opportunity that we are tapping, right?
No, so the manufacturers are spread out in different locations. So depending on where their plants are located. So the plants are located in North America and in Europe, as well as certain plants are located in Asia.
Okay.
You'll see a spread of, for the windmills, it will be going to the OEMs, depending on where their plant locations are. But otherwise, we are finding that on the cable side, our export growth has been in North America and in Australia. And we've just won a few World Bank projects in East Africa. So these are the three sort of geographic locations where we see maximum export in FY23.
Okay. Thank you.
Thank you. Ladies and gentlemen, if you would like to ask a question, please press star 1. Our next question comes from the line of Samrat Singh with PPF Capital. Please go ahead.
Thank you for the opportunity. My questions are regarding our cables business. So to the U.S., are we only exporting windmill cables, or are we exporting also on the telecom and power distribution side?
So at the moment, we are not exporting windmill. The export which we are talking about is all power cables. So these are going into the building industry and for general purpose cabling. So there's a big backlog of infrastructure spending that's there in the US right now. So it's going across the power industry segment, and most of the cables are actually light duty cables.
Okay, so but the capex that we are doing right now, that would be for windmill cables.
Yes, so the capex which is going in is for the windmill side, and the electron beams are largely going in. So some of the photovoltaic cables that go to the US market are electron beam cables. So there's basically two sets of cables going in at the moment. One is for light duty general purpose power cables going into the housing industry, building out basic infrastructure like warehouses, etc., etc. And the other section is going into non-conventional energy installations, and that includes photovoltaic cables, or what they call PV cables, which are used for connecting the solar panels.
Okay. But
it's a fairly wide range, and we have the largest amount of you require what is called a UL approval, Underwriters Limited, to be able to sell in the US. So at the moment, the cable division of Apar has the largest number of UL approvals of any Indian cable company. I hope that answers your question.
Yes, it does. Thank you so much.
Yeah.
Thank you. Our next question comes from the line of Sachin Shah with MK Investment Managers Limited. Please go ahead.
Yeah. I hope I'm audible.
Yes, you are.
Yes. Yes. Hi, Kushal bhai. Thank you for this opportunity, and congratulations for a great set of numbers. I think after 2-3 years, all your hard work seems to be paying off. So, Kushal bhai, even 2-3 years back when we were discussing this 550-600 crore kind of EBITDA number was what we were thinking about, and I think even to get a 20% kind of ROE, probably 750-800 crore kind of EBITDA number is what probably is now visible over the next 2-3 years. But if you can give us some sense, what beyond that, because now we are at a striking distance of that number on those numbers. So in sense that because we are going to hit certain capacity utilizations in terms of conductors or even on the cable side. So if you can give us some sense beyond that, beyond the next 2 years or so.
So I think at the moment, Sachin, what we've got clearly on the drawing board is what will take us through, FY23, FY24 and into FY25. So we continue to see the cable business actually will see the largest amount of growth over the next 3 to 4 years. And in that, there are, 3 major segments where we see the growth coming from. The infrastructure spend in the United States is just about to begin. So in fact, the actual formal allocation from the Biden government is still to come yet. So this growth is being driven by, the building industry and other infrastructure improvements which have started without the large amounts of allocation coming in. So clearly that is a program that will run over the next several years, and that's why we took a step of going ahead and getting the maximum amount of UL approvals for our cables. And also the conductor side has started seeing, the initial orders coming in from the infrastructure spend, though we expect that as we get through FY23, that will pick up. So getting to a 25-30% growth at today's commodity prices over the next 3-4 years on the cable side looks very much on the cards. In addition to that, the railways is going to spend a lot of money, and we have got not only products for the locomotives and for the coaches, but we also have started doing harness, which is a forward integration step in that direction. We've also started making harnesses for solar installations and wind installations. So now for many of our clients, rather than just supplying them wires on reels, we are buying the connectors and setting up the framework and supplying it to them. So, the cable side, these are the 2 major areas where, we'll continue to see growth. On the conductor front, as Chaitanya mentioned, there's more and more reconductoring work going on. And also OPGW is coming in place of just the normal earth wire. So this year is the first year that you will see a big jump, and part of that order book has OPGW ground wire in it. This also phenomena should run for the next few years. The domestic side has limited potential compared to what we see happening in the United States and some of these overseas countries, where there's much more aggressive non-conventional energy addition taking place. So a lot of new networks are coming up. So our sense clearly is that, the cable business will actually have the fastest growth rate over the next few years, and the conductor and oil will then, continue to follow.
Okay. And Kushal, just one more thing that, in the cables business, if I recollect, a few years back, maybe about 3 years or so, our margins used to be double digit, a little higher in the double digit. Now we are at closer to, say, mid-single digit. So some sense on that in terms of directionally, where do we see in the next 2-3 years? Do we aspire to get that double digit kind of margin?
So our aspiration certainly is to get there. If you see, last quarter was around 7% for the quarter. Right. It's little over 5% for the full year. Right. Next year we would expect to be in the 8%, kind of range, 8% range. Also, the other area where we are focusing on the cable side is to build out our network for the building wires. So initially the EBITDA will be lower because just putting money in, branding and network expansion, etc. But that fundamentally carries a reasonably good value addition. especially because of building wires that we sell are electron beam, and they are more premium compared to wires that are being offered, just using conventional method. So the cable business, you will see a EBITDA increase also happening, and our target would be that in FY24 we get closer to 10%. So the 8 to 10% range is what our expectation is. You got to keep in mind that in the cable side, the inflation has happened not only on account of metals, but the polymers have actually increased at the same pace as metals.
Sure.
So you're looking at a very inflated, raw material cost.
Right.
So, whenever that happens, the percentages obviously come under a little bit of pressure. So,
no, I appreciate it.
Our sense is that you will see 8 to 10%, that's what our target is on the cable side.
Okay.
If the value-added products in the railways and all that increases, and if the defense spending continues, then that gives us a 1 or 2%, additional top-up.
Right. And just one last thing from my side, that on the conductor business, like as you mentioned in your opening remarks, that the conventional conductors market is now started to open up. So obviously next year the conventional conductors will also increase. So effectively, the current EBITDA per ton that we are earning there should logically come down, right, by just the number math. And how? So will it be a significant down number from what we've done this year? Like earlier we used to do about 10 to 12,000 rupees per ton, which we have now done about 18,000. So where do you think we will now kind of settle with a balanced overall portfolio of the conductors?
So there are a couple of things here. One is that as we get into this financial year, we have some of the products that we took up during pandemic time, and those are of course at a low margin also because of the freight increase. So some of those orders will get executed in this year. Also this business has multiple product lines with a mixture of conventional and high efficiency conductor, due to which the margin has been higher this particular year. The coming year, we actually will see this coming down to about 14,000 per metric ton. That's the kind of aspiration that we have for FY23.
But then the volume will be higher. So you will still, the EBITDA per ton will, as you rightly pointed out, will come down as you start executing some of the conventional conductor orders. But the proportion that is there of these other orders also is not small. And the overall may come down from 17,000-18,000 closer to around 14,000, but the overall EBITDA for the business will grow.
Okay, so so you're saying the volume will make up for the entire thing, which means if the overall EBITDA, if you've done about closer to 180 odd crores, that number should grow for FY23 over FY22.
Yeah, so you take the multiplication of 100,000 odd tons you did last year multiplied by 17,500.
Right.
At 14,000, and then the volume will be higher for this financial year, because as the metal prices have steadied, so many of the EPC guys who had placed orders but were not actually pricing the metal, they will price the metal and start taking delivery now.
Understood. So that means
you have a little bit of reduction in the per ton basis, but the tonnage will go up, and we have the capacity in place to actually execute all that.
Right. So about 100 so effectively you're saying that 20-30% kind of volume growth should be there with 100 to going to 120, 130,000.
Yes.
Okay. And our capacity is about 150,000. So does that mean that we can manufacture so much? I'm not saying next year, but say FY24, 25, whenever as we grow. But typically, what is the utilization level for this kind of business? An optimum utilization level?
So we have several product lines, and we have a fungible capacity nowadays, and we have built in a lot of capabilities to move from one product to another, so that as per the demand we can sort of optimize the utilization. So we are at about 180,000 tons of rated capacity, but depending on the product mix, it would range from about 160,000 to 180,000 tons.
Thank you so much. Best wishes and congratulations once again. Thank you.
Yeah. Thank you, Sachin.
you. Our next question comes from the line of Ashit Koti, an investor. Please go ahead.
Sir, congratulations on extremely good numbers.
Thank you.
What I would want to understand is with rising top line, when do we see our net margin improving reasonably well, whereby any commodity down cycle or adverse movement in commodities can be managed much better?
So we do have a risk management framework set up wherein we kind of hedge our commodity cost, commodity raw materials there. So to that extent, our risk for the variations in metals are being hedged properly, and appropriately these are being passed on to our customers there. Again, as mentioned earlier, the value top line may not be a factor that we should see because it gets driven by the changes in the price of commodities there. But what we more measure is on the per unit EBITDA, which could be a number that we kind of look forward to.
So we don't really see, we don't see the same concern that you brought out over here if the risk framework is run properly. Where, with the movement in the commodity prices, we are focusing on absolute margins being maintained or controlled. There is no way in which our business can run on a percentage basis. Because when aluminum goes up from $2,000 to $3,000, like it went up,
yes,
the value addition that a customer will pay us will not increase by 50%. Because your cost of conversion, manufacturing, all that doesn't proportionately go up with the cost of the metal, with the purchase price of the metal. So the whole risk framework actually takes into account all absolute costs. Where you will have a percentage movement is to cover the financial side. The working capital, the rate of interest that is paid for the working capital cycle.
Right.
So our business, we don't run it based on a percentage basis at all. We are always running it on an absolute margin basis. That's why our reporting also is on a per KL basis or a per ton basis. In the case of cables, we are forced to give it as a percentage because the variety of product is so vast. And the value per kilometer produced, if that's the unit that one can measure, varies very, very dramatically. Can vary by 5 to 10 times, depending on the nature of copper, polymers, construction, etc. So you can go from 1 lakh rupees per kilometer to 10 lakh rupees a kilometer. So that's the only part of the business which is being forced to give it in rupee terms to find a common denominator. But otherwise, the businesses will be managed on an absolute margin per ton basis.
So how do we plan to control our interest charges, which has in fourth quarter specifically, it has got a substantial jump. So will that jump would continue?
Here also we will see an increase happening because, you've just had a hardening of rates taking place. And our working capital cycle we've been quite tight in terms of controlling the cycle. So the value addition or the EBITDA per ton, will have to take into account to compensate for that. So as you price, that's part of the pricing framework. So that portion is on a variable basis. The working capital component of the total conversion cost.
Do we plan to raise equity to bring down our overall to further reduce our dependence on outside capital requirement?
Not really, because we really don't need to raise capex. Our whole focus is actually to raise our earnings per share, which we have been concentrating on. And we are able to access the required working capital. So equity is a very expensive form, and we want to finally get to 20% return on capital. So borrowing today is still sub 10%, even with the expected increase in the rates. So our capital structure, we don't want to raise any more equity. Focus is going to continue to be on increasing equity, meaning earnings per share, And then hopefully with the business growing and the profitability of the business growing, the price to earnings will also, hopefully have a reflection of that.
Thank you, sir. And congratulations once again.
Yeah. Okay. Thank you.
Thank you. Our next question comes from the line of Akshay Kothari with Envision Capital Services Private Limited. Please go ahead.
Yeah, thanks for the opportunity. So just wanted to know, recently, around 6-7 months back, there was an opportunity wherein DRDO had developed a thing called quantum communication, and it also used some, photovoltaic beams to use cables of photovoltaic beams to establish quantum communication. So are we seeing any development on that side?
So we are not part of that program, but we work. We are one of the partners with DRDO in developing a whole lot of indigenization or Atmanirbharization of cables which are used in the defense sector. So every year there is a whole set of new products which we continuously do R&D on with support from DRDO and the Indian Navy. So we are not part of that project, but we have number of new cables that have been produced. In fact, the 2 new warships which were commissioned just in the last 15 days, our wiring has, finds its way into the instrumentation of both those warships.
Okay. So currently our revenue from defense sector would be around?
So, it's the business has been varying. It has been relatively low in the last couple of years because there was a lot of delays in terms of production happening at the different, particularly the concentration in defense is largely around the Indian Navy and instrumentation cables that go into naval vessels. So this year we would expect to do about, I reckon in the range of around 60 to 70 crores of cables that would go into the defense.
Okay. Okay, that's great, sir. And going forward, how do we look at the working capital cycle? So
I think our working capital cycle will still remain within the same. We've concentrated on keeping it relatively as tight as possible, and if we end up giving extended credit, it's generally given on letters of credit.
Okay.
So it allows us the flexibility to then discount the document and bring it into the cash flow.
Okay, okay, that's great.
But we are going to look at trying to contain the number of days. Focus is on number of days of credit which is being given in terms of debtors and inventory. But even if we contain the same number of days, there is an increase that is happening because of the interest rate. So that's something that we are factoring into our cost as we calculate, cost for our for quoting purposes, on tenders or to customers.
Okay. Yeah, that's it from my side.
Thank you.
And all the best.
Thank you. Our next question comes from the line of Samrat Singh with PPF Capital. Please go ahead.
Yeah, thank you for the follow-up. On the windmill cables that we are, the capex that we are doing, is there any sort of qualification or approval that is required when we are supplying to North America?
Absolutely. So those are we've already worked our way into getting those approvals.
Okay, and how long was that process?
Anywhere, it's taken over 2 years because the product is tested in multiple test environments and in multiple laboratories.
Right. And are there other suppliers from India that also have similar qualifications?
So there are suppliers who are also qualified, but currently our sense is that we have over 70% market share of the cables that go inside the windmill in the domestic market. And that's the reason why we've been shortlisted to be a global vendor. And for the last over 2 years, we've been working on, the overseas approval. So we have today approvals in place from GE, Nordex, Vestas, Siemens Gamesa, who are the big international players. So we have global approvals in place. We are currently servicing their domestic requirements with a small portion going overseas, because we have to increase our capacity to be able to service that business larger.
Right.
And with this capacity increase taking place, we should be in a position to do that. So in the contracts that run in the year 23 onwards, we would be in a position to participate with larger volumes.
Right. So these approvals are global approvals. They're not country specific. Is that how it works?
Yes. So some companies only offer a global approval. So either you are approved in terms of quality to supply worldwide. They may buy your products locally, but the approval is on a global basis. So and some of them follow a differential between regional and global. But for all the top 5 international, meaning European and US companies, we have global approvals in place.
So the cables for the windmill that will be supplying to North America, who would be our competitors for that?
So our competitors would be companies like Prysmian, which is the largest European cabling company. Nexans has just sold their their non-conventional energy and some of these flexible cable business. LS Cables is there. Then there are a few US companies like Hendrick Cables. So there are many cable companies around the world that also supply on these projects. The advantage we have here is that we are completely integrated. We make our own polymer, as in we do our own compounding, and we start right from basic copper rods and make the full finished product.
Right. Right. Okay. So and these competitors you named, they're largely European and North American. Is that right?
And Korean. So LS Cable is in the top 5 cable companies in the world, part of the LS group of Korea.
Okay. And so for these energy cables, is my understanding correct that there's almost a full pass-through of costs, at least at this point?
Generally it is, because you have pricing of copper, tin, all these things which go into the equation. So the metal portion is pretty straightforward. It's the polymer that requires a negotiated discussion from time to time, because it's based on proprietary formulations that different companies have.
Right. Right. Okay. So the metals, the contract itself will have a pass-through.
Yeah, exactly.
Okay.
And then you have periods where you can sit and then negotiate for changes in other costs.
I see. So a lot of these European competitors of yours in the space, I'm assuming with sanctions on Rusal, will have some sort of increased costs in obtaining aluminium and and copper. So would that benefit us in any way?
In fact, more than just the metal, their conversion costs have increased very substantially, because producing a windmill cable is consumes a lot of power, given that the compounding, and there's so many different manufacturing steps before you make a finished product, that it's it is reasonably power intensive. So utility costs in Europe have increased substantially. So I think sitting here in India, we are in a relatively sweet spot.
I see.
In fact, the dampener today is the freight. But as Chaitanya had mentioned earlier in the call, we've seen freight rates have stabilized. And if some of the consumer product, which has been going from China and other parts getting imported into Europe and the US, if that starts tapering off, then we could see, maybe freights coming off a little bit. Not substantially, but, may see it coming off. So once the pricing becomes steady, then an overseas supplier like us is also able to provide more stable pricing. So we see actually us being in a relatively sweet spot as we get into the next 2-3 years.
Right. No, I agree. I just two more questions on the same topic. If a wind power turbine is replaced or repowered with a more efficient, higher capacity turbine, then is there any additional cable usage that comes into play?
So what is happening is that as you go with a larger size turbine, the height of the tower increases. And as a consequence, the length of the cable that you use within the tower also changes. Secondly, the design of the cable changes, because when you go from a 1.5 megawatt to a 5 megawatt, basically there is a transformer that is connected to where the blades are. And so the amount of power that you need to then bring down through the shaft is also higher. So bigger the turbine, automatically the more complex and larger the amount of cable.
I see. And we would be supplying to the bigger turbines as well, right?
We've got approvals that go up to now 5 megawatt.
Okay. And last question from my side, do we, I guess we are doing this CapEx for North America, but you said the approvals are global. So, I mean, I think there's this, the German Renewable Energy Act, which is, supposed to have 10 gigawatts of annual onshore wind additions by 2025 in Germany. So would we have any exposure to that in any way?
Yeah, so these approvals are not, the product is not just going to North America. What I mentioned earlier was that we are seeing currently a growth in the export order book to North America. But if two of the largest companies that we are hoping to service are based in Europe, which is Vestas out of Denmark and Siemens Gamesa, which is out of Spain. So the windmill cables will go to Europe and the US. And in fact, some of their manufacturing or assembly operations which are in Asia also. There's a separate set of UL cables which are going into the United States today. And that business we see growing substantially in this FY23 compared to, it all started in FY22. So we'll see a full year impact of that in FY23 and hopefully carry forward into the next year also.
Okay, and then hopefully we start seeing these this European orders coming in later in our order book.
Absolutely.
Got it. Okay, that's it all from my side. Thank you so much.
Thank you.
Thank you. Our next question comes from the line of Himanshu Upadhyay with O3 Capital. Please go ahead.
Yeah, hi, good afternoon. I had a very basic question. See, this capex which is happening on the renewables, and we expected significant capex on renewables across the globe. But would not it mean that it will also lead to higher capex on transmission and distribution, because the generation has become far more fragmented and multiple sources of power will be there rather than the traditional power plants which used to be large single source 500 megawatt gigawatt type of power plants, but small various number of generator stations. Okay, so and even in case of US, when we are saying that renewables will play a bigger role, so would you expect the other businesses of conductors and transformer oils also should be benefiting in a similar proportion, or but just because we were not present in cables and hence cable can be a greater growth driver, but for the industry as a growth, these two other segments will also be equally good.
Yeah, so let me and Chaitanya can actually answer that in more detail. But absolutely the other segments will also grow. In the case of conductors, you need conductors to evacuate power from any of these locations. So, but Chaitanya, maybe you can answer that question more specifically.
So the places where the renewable energy is being set up, are different from the traditional places where the thermal power is to get generated. So it is all over the place where there's a coastal area, or in some cases where there's more desert, more solar availability. So accordingly, there's a lot more robustness of the transmission and distribution system required when we have the renewable energy, because for part of the day, the power flow would be from one direction to the other, and it is possible that for the, in the night hours or in the monsoon season, the power flow may be the other way. So the type of transmission and distribution requirement is also a little different in terms of the robustness, and also in terms of the multiple areas where the network has to be connected to the main grid. So the nature of the network is a little different from the traditional what used to be there, when only thermal power used to be in place in most parts of the world.
Yeah, so it will also benefit the primary two businesses. We have large global presence.
Yeah, so the cables business actually, the intensity of cable consumption is much higher generally than conductors and oil. So you will see that as infrastructure is growing, the absolute value of cables will grow at a pace which is faster than, like for example, you take the Indian market, the cable business including building wires is a 60,000 crore market. So it's 10 times the size of, I won't say 10 times, but about 6-7 times the size of the conductor market. So, but what you are saying is absolutely will happen. The conductor business also will grow. The oil business is directly proportional to the addition of transformers. So as the transformation capacity is put up, it just grows linearly with that. Because till date, for this sort of networks, you can't use anything other than oil-filled transformers. This is a direct proportion increase. Either we will get the business or, some of our competitors. We don't really sell transformer oils in the North American market, because North America is one of the largest producers of transformer oil and is sold very domestically. But we will see the growth happening in other geographies.
Okay, and one more thing. In case of cables, you have told us renewable cables, the requirements would be slightly more sophisticated, or let's say windmill would require a higher torque, withstanding cables and all that stuff. But will the requirements on our cables and transformers also change something because of when you are saying that the power movement can be on both the side, okay, not just two, but the system may have to go have a power transfer.
The transformers are getting redesigned. Obviously, there will be a larger capacity transformer that goes up, in the windmill. But there's no change in the design of the oil, because these are actually very small transformers compared to the really big ones which we are supplying. So we go right up to transformers which are able to carry up to 1,000, over 1,100 kilowatts, transformers which are there. So there's no change in the design of the oil. It's just that the applications will keep on increasing and the oil will go into those.
Okay.
In the case of the cable, there's a fundamental change in the cable design required. Because you're going from a 1 megawatt or 1.5 megawatt turbine to a 5 megawatt turbine. Whereas our oil is good for handling, wide ranges of megawatts.
Okay. And the competitive intensity is also much lesser in cables versus transformer oils in North America. That would be
yes, and in North America, there's a lot of infrastructure coming in. Right now, what's going in also to a large extent in the building industry. So expansion in house, for housing complexes, warehouse complexes, all these things.
And in case of conductors,
spend is still to come.
Okay. And in case of conductors, also the situation would be similar in North America like transformer oils, or it will be different?
No. So that maybe Chaitanya you can.
Yeah, I actually wanted to add something to the previous question. That in the case of the renewable energy, what we are seeing is that a fair amount of new lines are also coming up with the high efficiency conductors. In the past, it used to be mostly used to debottleneck certain transmission lines which are feeding the power to state capitals or important cities. But now we are seeing that actually even in new lines which are getting connected from the solar parks or wind mills parks to the grid, that all is coming with the high efficiency conductors. So this is the robustness that we were talking about. And in terms of the North American market, we are seeing a fair amount of new lines coming up, again driven by the renewable energy. One focus is that. Second, there is a lot of revamping of old infrastructure, because every 40-50 years the old lines need to be kind of revamped. So there is a lot of requirement of conductors also required on this account. These are the major things which are going on there. Then of course, as discussed earlier, where the American market used to buy a lot of conductors from China, and that is now somewhat muted. So they are giving Indian parties a good chance to sell to the North American market. So these things are helping us to drive our demand in the North American market.
Okay. And one last thing on Hamaria, the oil segment. We are getting that 104% capacity utilization. Would we require to do another round of capex, and are the local markets doing well, or the end customer for that is across the globe? Can you say some light?
Yeah, so we've already gone through. We are in the process of completing an expansion, debottlenecking, I'd say, in the plant, which will increase the capacity by around 25%. And we're in the process of just getting all the final approvals to have all those tanks, etc., commissioned. So that will happen in the next couple of months. More importantly, your question in terms of local demand. So the local demand actually will get stronger, because it's still dependent quite a lot on the oil and gas industry. So as the oil and gas industry, the prices of oil and gas increase, the spending that happens in the GCC and North Africa and all those areas, they tend to grow.
And the end market for our
expectation is there will be more sale happening in those areas.
Okay. And the end markets are generally the local markets, or we export from there across the globe?
So between the two plants, depending on where the logistics are the most suitable, we are selling to 125 countries. Between the manufacturing plant in Mumbai and the plant in Hamaria. Obviously, the Hamaria plant caters to entire GCC and North Africa. But from there, we are also exporting to Australia, for example, because the freights are lower from there to Australia than to India. So we use both the plants depending upon where the freight and logistics is best, provided the products are made in both locations. So transformer oil and the basic range of white oils we make at both the plants. It's the industrial, automotive and specialty products which are made only in the plant in Mumbai.
And one last thing. We were buying molten aluminium, okay, for our Odisha plant, okay. And we believed some amount of efficiencies we can get, because we don't need to recast into the cable in our conductors business. Have those efficiencies played out the way we were expecting those things to happen?
Yeah, it has. On the contrary, we've actually, seen better economics, because the furnace oil prices have gone up. So to that extent, our cost reduction compared to our competitors, we are in a better situation.
Okay. Thank you from my side. Best of luck for your future.
Yeah, thanks.
Thank you. Our next question comes from the line of Chetan Dhruva with RIA. Please go ahead.
Hi. Thanks for the opportunity. Can you hear me? Hello?
Yes, please.
Can you hear me?
Yeah, yes, we can hear you.
Okay. Congratulations on a good set of numbers. I just had two questions. So you talked about the conductor EBITDA per unit volume reducing. I had a same question for your transformers and specialty oils. You mentioned that higher prices may actually moderate the demand, but do you see the per unit EBITDA continuing to be at these levels? Or because I remember your earlier commentary stating that you expect the EBITDA in steady state to be around 5,000. I'm sure this is far from steady state, but some approximate indication of where you think this is headed.
Yeah, so we, 5,000 is the minimum, sort of targeted EBITDA per KL that we are targeting, that we would like to have. So as was mentioned in the commentary, we are going to focus in this year, on unit economics. Because unless you get your unit economics right, there is a big jump in the price of raw materials, and it's still continuing to increase. I don't think, unlike in the case of the metals where it has started settling down at these levels and may actually come down a little bit from its all-time highs, the hydrocarbon side, I don't think one can comment on that basis. So obviously our target is to get to 5,000 rupees a KL and higher, because the interest component also will be a larger working capital piece, given the the per liter cost of any of the oils. But we are a little bit more muted in terms of, it's unpredictable in terms of how the demand will get affected. Because in some of the products, especially industrial automotive, customers can increase the useful life of the product and, do a replacement later on.
Okay.
It's not going to happen in the case of transformers, because transformer oil forms only 5% of the cost of the transformer. So that will be dependent really on the expansion of the transformation capacity and number of transformers getting laid out. Where that has been a little bit slow in India at the moment is that the state governments have really not been able to keep pace with what they need. So the center is coming up with a whole set of new plans with strings attached. So if that happens, then again you will see a spurt taking place. But otherwise, for other products, we don't know how demand could get affected given the where these prices will finally land up. You may even see a reduction in consumption of gasoline and diesel. India has still not seen the sort of increases that some of the other countries have seen. But the commentary which we are hearing, and you probably have access to also, which is the Bloombergs of the world, it seems like, even oil companies are expecting that there could be an impact.
Mm-hmm. So do you actually foresee a potential decline in the segment, at least in terms of volume and also in terms of revenue this year, or you expect to maintain?
We mentioned in our commentary saying that, it could happen. The good thing is that we have a set of three businesses here, and the oil business, the numbers will still we don't know whether they'll be as good as what it was in the last 2 years, which were 2 excellent years that we had. But our cable and conductor businesses will actually kick in. And if there is any slack that comes from the oil business because of the current hydrocarbon situation, I think it will get more than compensated by the other 2 business segments.
Okay.
So I think overall we'll still come out much ahead.
Okay. Just one more question then from my side. On the capex for FY23, any specific guidance you have?
So the capex for FY23 actually carries a significant carry forward from what was planned in the last year. So we'd see about 130 to 150 crores worth of capex taking place, but half of it is actually carry forward from projects which we initiated the previous year, because the production lines and things have taken a little longer for delivery to take place.
Oh, okay. But totally you're looking at around 130 to 140 crores in the year, not more than that.
Of which half of it, about 70 odd crores, is actually capital work in progress or equipment which are on its way here, which are getting commissioned.
Understood. So thank you, sir. Appreciate your responses and good luck for the upcoming quarters.
Yeah, thank you.
Thank you. Our next question comes from the line of Nimish Shah with MK Investments Managers Limited. Please go ahead.
Yeah, thanks for this opportunity and congratulations on good set of numbers. So I had one question on our lubricants business. So if you could just share your outlook and your strategy on that segment for us, and just wanted to understand, are we winning market share or winning new customers in that segment on the auto lube side?
So on the lubricant side, we continue to actually bid for more and more business from OEMs. And on the tractor side, we've added more volume from the amalgamations group. So that you will see more volume from amalgamations group coming up this year. So there are two parts to it. One is a first fill and the other one is the aftermarket. So we've been dropping some first fill business and focusing more on the aftermarket business within the OEMs. So we continue to see some amount of growth happening there. But our sense is that lubricant demand itself will come down. Because, as the ticket size of 1 liter of engine oil or gear oil increases, the customers tend to then run the change period longer before they will actually make the change. So on the retail automotive side, we don't expect any major growth to happen. Whatever growth will happen will come from network expansion, which we are doing. On the other hand, on the industrial oil side, we have been seeing growth, and that is a proxy to the industrial activity in the country. So we had a 20% increase in volumes last year, and we are targeting 10% plus increase this year on the industrial lubricant side.
Understood. So in terms of your volume mix, so currently lubricants will be about 14% of the overall oil business. So do we expect that to improve going forward?
Yes, it's more than if you take the automotive and industrial put together, it's a higher percentage than that.
Okay.
So, the lubricant revenue came in at almost 800 crores out of 3,600 crore total revenue.
Right. Okay. Got it. And few bookkeeping questions. If you could just share the LCs for the period and the debt figures in forex and domestic currency.
Yes, the long-term debt stood at 253 crores. We had a cash and cash equivalents about 297 crores. There were no short-term debts. The interest-bearing LCs in forex is about 1,600 crores and domestic is about 1,200 crores.
Got it. Yeah, that's it from my side. Thank you and all the best.
Yeah, okay.
Thank you. As there are no further questions, now I would hand over the conference to the management. Please go ahead.
Yeah, thank you everyone for taking out the time for our earnings call of FY22. Just in terms of just closing remarks, we are quite optimistic, as you've heard through the narrative of the call, as we get into FY23 and into the future. The conductor business has a strong order book. We expect business also from the overseas markets, and that is also reflected in the 3,000 crore order book that we have. On the cable side, we've got non-conventional energy and the growth happening in our wires and LDC business where we are growing distribution. So all of those are kicking in. We are quite optimistic as we go into the next year, and thank you for your time on this call, and hopefully we'll have interesting financial numbers, for the quarters to come. Thank you very much.
Thank you. On behalf of 4S Services and Apar Industries Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.